to borrow against your home. Now, depending on whether you have a lot of equity or you own it free and clear, there's options that are going to be available to you. My name is Arjun Dingra, and I'm a contributor here for the Mortgage Reports, which I think is one of the best resources out there for people that are looking at real estate or professionals that work within the real estate community. We appreciate you watching and tuning in on this very important topic, which I will get into now. So if you own your home free and clear, then congratulations, you won the first game. And if you have a lot of equity and it's continuing to build, you're on the same pathway. So kudos to you, whichever camp that you actually fall into. Now, I want to make sure that you don't lose the second game by borrowing in the wrong way. Now, where a lot of the thinking comes from that I want you to actually avoid in this scenario stems from, or can be actually referenced quite clearly, to the 2008 market crash. A lot of people in the United States were buying homes that were appreciating rapidly. And so with that equity just kind of sitting there, because you look at it and it's lazy money, meaning it's not earning anything for you, people had this strong desire to do something with it. And the problem was the something with it was not in their best interest. Very few people in the lead up to the 2008 market crash actually used their home equity for anything productive. A large number of Americans paid off debt only to get themselves right back in it. And sadly, a significant amount of the population actually borrowed against their home to buy things: boats, cars, jet skis, taking trips, effectively turning their home equity into a personal slush fund. But what happens there? These things that you purchased or paid for or experienced don't actually increase in value, and the bill is still due on them. And so you've used some of your home equity, or all of it in some cases, to do all of these things. And then when the market corrected, home values dropped, you were actually upside down. You had no equity, which means there was no true value in being able to sell this house and get out of it, because you would owe money at close. This caused a lot of people who no longer had skin in the game, or equity, as we like to call it, to walk from their homes or just go up to the bank and turn in the keys saying, I don't want it anymore. I worked during this time in the industry and owned lots of properties, so I saw it firsthand, devastation, but also the mistakes that were made in coming up to it. Since I've been in the mortgage industry, from that time forward, it has been my sole mission to make sure that people make smarter decisions when it comes to taking out mortgage debt. Now, a home and its equity can be a tool if it's utilized the right way, if it's done responsibly and put forth towards things that are either going to be defensive, meaning cleaning up your financial house, and we'll talk about that here in the video, or going on offense and putting the money to use where it's going to earn you a better rate of return than where you borrowed it from. So let's get into the first option of borrowing against your home. This is probably one of the most common, and what I see as a mortgage professional pretty fluidly over the last year and well into this year, and that is a cash out refinance. Now, a cash out refinance is exactly what you think it is. It's refinancing your existing debt, taking something out on top of it, which effectively is the cash out portion that is given back to you at closing. Now, there are a lot of benefits for doing this type of loan. When compared to the other options that I'm going to go over with you, it will likely help you land with the lowest interest rate. It also has the longest commitment, meaning it's probably on a 30-year term, so that you have payment security, meaning your payment is fixed. No surprises, always predictable. Downside to this type of a loan is that there's no flexibility, because again, going back to the previous caveat, it is fixed. Now, this is great for long-term capital needs or for debt consolidation as well. It's not the best if mortgage rates end up dropping a little bit later, but there are no rules against refinancing or restructuring this debt to a lower rate should it become available in the marketplace. So that's a fixed rate option, and I'm going to cover one other one, which is called a home equity loan, or a traditional second mortgage. Now, this is not to be confused with the third option, which is a HELOC, but rather a second mortgage just goes into second position. It's structured very similarly to your first mortgage, but it's obviously just much smaller. It has a set period of time on it. There's an amortization schedule with the payments, and the interest rate is fixed. Now, this is a simple loan. They're generally very easy to execute on, and it's good for a one-time expense, meaning you were investing into graduate school or your children's college education, and you wanted to pay a few years of tuition all up front, or for doing a home improvement. So while these loans are not adaptable or flexible, they are very good if you have a clear vision of what you need the funds for. So now, option 3 is a HELOC, and a HELOC is kind of a household term. A lot of people know what HELOCs are. It stands for Home Equity Line of Credit. Now, this is going to be one of the more flexible options, and you want to think of this as a gigantic credit card. So let's suppose you take out a $100,000 line of credit against your home. Well, the good news is you only make monthly payments based on the amount that you owe, not based on the entire line of credit. So in that $100,000 example, if you only borrowed $20,000 because you had an immediate need for that cash, then your monthly payments are only going to be based on the $20,000 and not the $100,000. Now, these are generally attached to adjustable interest rates, which means, say, for example, every time the Fed moves their key interest rates, it's going to cause an adjustment with your payment. And in the current environment we're in, which is a rate cutting cycle of some kind, that could be a good thing. It's a very powerful tool if your income is stable, and most wealthy Americans have a HELOC of some kind attached to all of their real estate. They want to be able to tap tap the equity and deploy it for either another investment, a major improvement, or putting it into more real estate. And the best part is, because it's debt, it is not taxed. That's kind of a rich people's hack. Now, it is very dangerous if, when we compare it back to 2008, if there's no lifestyle discipline that's attached to it. If you start thinking of this credit card as something that you can just kind of live off of and that it funds your lifestyle, then it is inevitably going to turn into the same trap that it did for millions of Americans back leading up to 2008. If you have an actual valid and substantial need for the cash, then a HELOC is a great tool. It's also fantastic for consolidating debts, which a lot of Americans are carrying right now, considering that credit card debt is at an all-time high in the United States. The last option is called a home equity investment. Now, this is really rare, and it's also something that you want to consult your financial advisor on, as well as the lender that's currently holding your mortgage. Basically, there's no monthly payments. The approval is very easy to obtain, but you are basically selling future upside in exchange for some money right now. So in appreciating markets, this can be very expensive. Now, this is one of the more risky options, and again, likely why it is the least popular option of all four. But in the right situations, for the right people, and in the right markets, it can make sense. Again, just putting it out there, you should absolutely consult with a wealth advisor or whoever handles money for you before even thinking of taking on such a loan. Okay, so how do you decide between these four? You need to ask yourself some key questions. What is the money for? How long will I need it for? Is it because we want to add on to the house and create another bedroom and bathroom, which would increase the home's long-term value? Or because we have $50,000 in credit card debt and we want to pay it off because we feel like it is just squeezing us? And the last and very important question to ask yourself is, what will happen if our income changes? Meaning, should someone in the household lose their job or take a bit of a pay cut? Will we still be okay making the payments back on any one of those four options? As long as the answer is yes, and you feel responsible and stable in the other questions that I asked, then it can make sense to borrow against your home. Look, at the end of the day, that money is just sitting there. It's not doing anything. But as long as it's put to responsible use, it can actually be a weapon for creating wealth. So in closing, I will tell you that debt isn't good or bad. Unintentional debt is a bad thing, which is why it's very important that you borrow with a plan and not a feeling. Thanks for listening, guys, and we'll catch you on the next topic here with the Mortgage Reports.